individual year. So you have negative cash flows for the whole development time. So we are talking about pre-revenue companies. So when we do evaluation, you know, these companies, they normally never have revenues. That's all cost for a long time. And often then the product is being licensed or sold before, you know, it gets to the market. But still, we are looking at the whole time frame, and so we are trying to see what are the cash flows, positive and negative, of that particular product. And this is always independent of who owns the product. If you license it out to somebody else, it doesn't matter. At the end of the day, the partner will also have cost for the clinical trial. So we try to do that, look at it from an independent point of view.
Could I,
yeah.
Is it okay to ask questions?
Yeah, yeah, absolutely,
so
absolutely.
Let's go through with that exact case. So if you're developing a therapeutic or whatever it is, and you're expected that in the end you're not going to take it to market, but you're going to license it to somebody. And I as either an investor in that company come to you, I as a company come to you and say, can you do an evaluation of the value of this thing we're developing? What are you setting the value up? Are you projecting what licensing fees, or how are you actually doing that combination of valuation?
So the first is what we do, the valuation of the product, because that's going to get to the market, and that will also, the value of the product will determine what kind of licensing deal you can get at the end of the day. But first we do the valuation of the full product, because most of the companies will out-license it. They'll have to out-license it to a big pharma company, because you can't take it to the market yourself.
Right.
I mean, that's, in most of the cases, that's the normal business model.
Yep.
But so we do still the valuation of the whole product.
One thing that I'm surprised is not there is related to the market timing. So, for example, immuno-oncology 10 years ago would have had a certain value. Immuno-oncology today would have a different value. The same with artificial intelligence. There's an aspect of what's going on outside with other companies, what's hot.
Yes. So so you have more the fundamental valuation, and then you have the pricing. You know, certain things are hot and people want to invest in that because they're willing to pay a higher price, because, you know, they want to be part of it. They don't want to miss the boat. Yeah. So that also drives the price at the end of the day. So valuation, and, you know, doing evaluation is kind of providing this basis, but then you have these different external factors, which, you know, you are in a technology which at the moment nobody is, you know, is interested, but tomorrow, you know, everybody thinks this is the hottest thing, and then, you know, there will be much more interest, and people are willing to pay a higher price for that.
So also, we recommend also what I call a nuisance fee, that if you've got a technology which another competitor don't want to be on the market, you get also value to that.
That somebody wants to buy it and get a hold of it. No? Get you out of the... I mean, you could, but at the end of the day, well, these are then special cases. You could take that into account as well and see what's the value then to somebody else taking you off the market. Or sometimes you can also, when you do you know, mergers, that's more with a technology. Somebody can buy the technology and enhance their own products. So there's different ways of looking at that. Yeah. I mean, this is more kind of just the basic. What are the basic for valuation? There's a lot of other factors, obviously, to take into account. Yeah. So, RMPV, I don't know if you guys know or have heard of that. So this is the risk-adjusted net present value. So net present value, obviously, future cash flows, and you discount them to the present value. Now, risk adjustment, what you do is you split the risk into two different factors. One is in the development phase, you have, you know, what is the probability that you actually can go into clinical phase 1 to phase 2 to phase 3 and getting it to the market. There are probabilities of, you know, statistical or historical data. What is the probability for an oncology product to get all the way to the market, or for a CNS product to get to the market? So this information, I'll come back to that, but this information we can use. And then you have kind of the non-specific, the non-development specific risk. This is the management. Can you get financed? You know, there's other risks which are independent from this development, product development. And that's in the discount rate. So usually, all the risk is usually in the discount rate. Now in this case, with the risk adjustment, you take the risk apart. And I'll come back to these individual steps. So we have a development phase, which, you know, is, we have negative cash flows, and then hopefully we have revenues at some point, where you have positive cash flows, and somewhere the patent expires and you have, you know, competitors coming to the market and so on. So what I try to do now is explain you step by step how this RNPV, risk-adjusted net present value calculation works. And that's when we do valuation for companies or for products, that's exactly what we use. That's what we do every day. So basically I tried to segment it into 5 different steps to do such a calculation. And by the way, I put these slides on our website so you can download them afterwards. Makes it easier as well. So the first one is to look at what is the development cost and timeline. You know, what kind of clinical trial cost will there be for this product? And again, independent if it's out-licensed, if the biotech does it or if Big Pharma does it. You know, the cost will be there. So we'll try to see what is the timeline for that and the cost. Then looking at the market, you know, how does the market look like? What kind of revenues can you generate? What kind of pricing? How many patients are there? And so on. I'll come back to that as well. Then the discounting. So, you know, there's going to be revenues in 10 years. So the present value of that is lower. So we discount it to the present value today. And then the adjustment for the risk, the development risk, the R in the RNPV. And I go through all these steps to kind of try to illustrate that. Yeah?
And how do you take into account multiple indications?
So multiple indication, you would do multiple valuations. So we would, you know, you have different markets and you have different timelines, you have different costs and gives you different values for the product.
When you add together?
Yeah, you sum of parts. At the end of the day, you would add up the different products or different indications you have. But there's always, you know, at the end, the company only has so much resources available. So even if a company has a platform, you know, they will not develop a product, you know, 20 products at the same time. You have to focus your human resources and your financial resources. So whatever is possible with the available resources, we would include in the valuation. Or sometimes also you have a product which is you know, applicable for a multiple of different indications. You would not develop all the indications all at the same time. You would go for, often people then go for orphan indication, a fast one to market, and then afterwards you would go with another one, maybe a bigger one. So that's a realistic scenario. So I have an example just to also again to kind of illustrate every step. So I will use that for every step and show you kind of the impact. Now this example is will be a phase 1 product. We use a discount rate of 20% and the probability that we get from phase 1 all the way to the market of 11%. So 11% probability that the product will make it to the market. And this is a realistic probability, and that's quite standard. So it shows how risky this industry is. So if you look at just the cash flow from this product, what are the cash flows in the future if you add these up? All the cash flows, the green, it gives you about $2.2 billion. Right? Now, if we discount the cash flows, so we discount it with the 20%, the discounted cash flows is about 120 million, 127 million. Because these cash flows, they occur very much, you know, far away in the future, 10 years and more. So discounting it back, you know, reduces it to about 127 million. If we do the risk adjustment now, you know, that there is only an 11% probability that actually the product will get to the market and generate these cash flows, these positive cash flows, the value of that product would be 8 million. So you can see the impact of the discounting and also of the risk adjustment is quite substantial. So, yes?
the discount rate already assume a certain amount of risk?
Yes, but not the clinical risk. So that's kind of where we split the risk into two parts. One is kind of the general risk, management, finance, and here is really the clinical risk. If we would not use the probability for the clinical trial, you would have to increase the discount rate to a much higher level, maybe 50, 60%. Then you would include all the risk.
So if I'm hearing you then, the discount rate is not a time value, it's not just the time value of money discount rate.
No, that's one thing, but it's also the risk that you will not generate these cash flows because the management will fall apart, or the company cannot raise the money to do the next clinical trial, or there is some maybe there's some regulatory impact that there's certain risk involved, which is it's not just the time value of money. So
I think
yeah.
there might be a double counting when you do that. There is a double counting because this is already factored in your 11% probability of success.
Yeah.
I'll come back to that too. We go through now every step, and we have the discount rate and the risk. So I'll try to show you that. I know where you're coming from, and you would say, well, but when they calculated these risks, these probabilities, they checked, the endpoints. Was it successfully achieved or not? It was not, if the company didn't get any finance to continue, that was not included in the statistic. So there's certain risks. There's only the clinical development risk were included in the statistic.
So one's the technology product risk and one is everything else?
Yes. It's the development risk, the clinical development risk. Yeah, yeah.
Commercialization.
Yeah.
It doesn't work.
I mean, exactly. So exactly. Yeah.
So that's your 11% success rate.
Yeah.
All other risks, corporate, community.
That's all in
all
the discount rate. The discount rate, correct. Yeah.
So just to say, Asan, are you assuming that sort of generalized discount rate is common across industries, or?
Yeah, where does it come from?
I'll come back to that as well.
Okay.
Yeah. We'll go look at the development market and then we'll look at the discount rate. I have a few slides on that, but it's not an easy question, trust me. So you could do a whole morning just discussing discount rate, but I will try to give you hopefully an answer to that. Now, the development, would be the next step. I'll go quickly through that, and then we can spend maybe a bit more on the discount rate and risk. But looking at the development cost, how long will the trials be? Where would you do the trials? How many patients do you need? So you can calculate and you can estimate these costs relatively well. You can also look at other companies, what kind of trials did they do, how many patients did they include, how long did it take. So we try to estimate these costs and these timelines, also looking at what are the manufacturing costs for, you have to have material that you can, GMP material that you can give to the patients. And that's often underestimated, so that can be quite costly to do that. You have to have people who understand what does it take on the regulatory side. So work with the CRO or have somebody in-house who understands the process, who can manage that. Tox studies and so on. So there's certain costs involved in this development. So here is just to kind of give you an idea. We look at the timeline. How long will it take? I mean, I made it quite easy. 1 year for phase 1, 2 years for phase 2, 3 years for phase 3, 1 year for approval, number of patients, cost per patient, and then what are the patient costs, and you have administration cost, you have CRO cost. So you can try to calculate what are the costs for different trials. So this is, yes?
What do you do for products that don't have clear development stages, like healthcare IT, for example?
Well, here the risk adjustment becomes more difficult because you also don't have. So here we would normally do a discounted cash flow. I mean, we do different valuation, but discounted cash flow, market comparable, We do venture capital method, so we look at what kind of exit price could you get, and so the whole range of things, how you can do the calculation. But this is really for therapeutic products,
Yeah.
diagnostic, medical devices where you have clinical trials.
Yeah.
Good. So the development cost is one side, then market. You know, trying to see what is the revenues that you can achieve with the product, with the product that you have. So you can do either a bottom-up approach. You can try to see, you know, how many patients, what is the cost per patient, so we can calculate that bottom-up, or top-down, looking how does the market look like, what kind of market share could you get. Normally we do a bottom-up value calculation, so really starting with number of patients and calculate that, and then compare with the top-down to see how does the market look like, and does that fit. Not that we calculate bottom-up, you know, 20 billion market, and actually today the market is only, you know, 500 million. You know, then you see there's maybe something is not right, or you really have to expand the market, and there must be a good reason for that. So here, what we also try to see is what is the life cycle of the product, and here it depends what kind of product it is. If you have a life-saving product where there was nothing, and maybe even an orphan drug for an orphan disease, you know, you would get to peak sales very quickly because you know where the patients are. There's nothing out there, so you know, as soon as something comes to market, it will be very quick, and you will get to peak sale. If you have a product which is distributed through general doctors, and there's other products out there, so you may have a certain increase, so then it takes much longer to get to peak sale because you need the marketing, you need to convince a lot of doctors to maybe change something, use a different product, try it out. So then the whole life cycle, you know, takes longer to get to peak sale. And on the other side also, depending on IP, depending on the patent, you would assume after peak sales at some point the revenues will go down because you have either generic, biosimilar, or you have new products coming to the market who will, you know, take market share, and the product will go down in terms of achieving revenues. So what we do in the bottom-up calculation, so we look at the incident rate, so how many patients actually have the disease, how many actually diagnosed, how many can you treat with the drug that we have. There's, you know, often just a subpopulation because of, you know, different conditions, other conditions, because of age, because of, you know, a lot of different factors. So you can't treat everybody with the same drug. Then you have compliance. You know, people, even though they have a disease, they might not take the drug. They don't want to take it. So you have an addressable population, and then we look at, you know, how fast can you penetrate the market and get to peak sales. We have a market share. We have a price. So these are the factors that we try to use to calculate what are possible revenues on a year-by-year basis. And you can do that, you know, on a European, Japanese, US level, or you can start breaking it down. In Europe, you would have different countries with different prices. You can, you know, you can become more and more sophisticated. But at the beginning, you know, I think normally looking at the big geographical areas is sufficient to do evaluation. Now, if we use the example I showed you before, the phase 1 product, there for this 8 million value, we had peak sales of about $1 billion. So the peak sale. If now the peak sale dropped to $700 million, the value drops to $3 million. Or on the other side, if we can increase the revenues of the product, peak sales, to 2 billion, so we double it, the value increases to about 25 million. Now the reason why it's not, you can see it, you would expect maybe it should double, but actually the reason is because your development costs stay the same. You know, if I have 1 billion or 2 billion in peak sales, my development costs will remain the same. So that's, you know, you have an over proportional impact in terms of the value. And also, on the other side, you know, my development costs, even if I have only 700 million in peak sales, my development costs are the same, so the impact is also over proportional.
So is peak sales the highest that sales ever get?
Yes.
So why do you do that instead of like area under the curve so that you get the breadth of the?
It's normally a lot of pharma companies, they talk about what are the peak sales, and analysts talk about peak sales. I mean, you could do that as well.
Assume some sort of even
Yeah.
distribution, like that's going to generate X amount of dollars over the life of the product.
Yeah, you could do that. The thing is then how far out it goes, and then, you know, on the back end, you know, you can include a long period or a short period, and that makes it then quite a difference in terms of. So peak sale maybe, yeah, it's just a way that people look at on the sales side to give you kind of what are peak sales, and then you have, is it a blockbuster or not? You know, if you're above $1 billion, it's a blockbuster. If not, then not. So. Good. So now discount rate, right? So now it becomes interesting and difficult. Now, as I mentioned, so that the discount rate, so that does not include the risk for the clinical development, the non-development associated risk. Now, what kind of discount rate do we use? And that's the magic question, and I don't have the perfect answer for that. There's different studies. There are different, what people often do is, depending on the stage of the product or the company, they take different discount rates. Again, kind of reflecting the risk also of the company to be able to get financing, or that the management has experience, and so on and so forth. And the later stage, the lower the discount rate. So that means the lower the risk.
Can you just define what you mean by early, mid, and late?
So this would be kind of preclinical, early clinic, late clinic. But it's there's no kind of set. This is the discount rate that people use. One of the things, maybe one thing, big pharma companies have a different discount rate, right? They have a much lower, and the reason for that is the way how they finance themselves. So the discount rate also reflects the cost of capital. So what's the cost of capital? The cost of capital to a biotech is higher than to a big pharma. Big pharma can get debt financing, and with a low interest rate, you can reduce your cost of capital dramatically. Right? So big pharmas have normally discount rates below 10%. Yes.
Is there some literature about that? In native medicine, there's some room from the United States which is often publishing this.
There are some publication, even, I mean, this is from a publication, but it's not, there's no scientific way to say this is the discount rate that's being used.
Because I think they've used about, let's say, 1,000 or 2,000 possibilities from startup. That's what I read in the
For the discount rate, or for the probability of success? Yeah, so that I'm talking about the discount rate here. The probability of success is the next one. So that there we have statistics, and I'll show you that. This is just the discount rate.
It depends, I would say, greatly about for whom you are doing evaluation. For example, if you are doing evaluation for licensing to a pharma, in fact, by the time you do the evaluation, the pharma discount rate should be taken into account because they will take over the product.
Yeah.
Versus if you do it, I guess, for investor, whether you were thinking about proceeding on your own,
yeah.
That maybe in that case.
A big pharma company would strongly disagree, because, and I mean, you're right on one side, for the big pharma, they can pay more because their cost of capital is lower. But as a big pharma company, I would tell you, well, this is my benefit. I have this low cost of capital. I'm not going to share that with the biotech. This is my benefit. So I'm not going to use my low discount rate to give you more money. This is the argument of the pharma. As a biotech, you could say, well, you guys, have your cost of capital is much lower, so you can pay more money. So at the end, it comes back to negotiation. How badly does the pharma want your product, and the biotech, how badly do you want to out-license it? But I agree with you. It depends at the end who, for whom you do the valuation, or what's the purpose of it. Correct. Yes?
Do you have data from yourself about these sort of figures?
What? Yes, I mean we use actually similar discount rates. So we use somewhere between, if we do it for biotech, it's somewhere between maybe 14 to 20%.
Have you reevaluated all these figures later on, because you're now more than 10 years in the market? So
Yeah.
have you reevaluated all the figures?
Well, we have reevaluated all the valuations we have done in the past to see what have people paid afterwards. So we have done that, but this was more for the company valuation. Because for a licensing deal, people do a deal. They don't put necessarily a value on the product, but they do a deal. So you can then calculate the deal. But that, it's the question is then how much of the value does the licensee and the licensor get. So it's a bit more complicated. So it's not black and white for that. So for the company, it's easier when you have a valuation and then a financing round. You can see what value did the investor put on the company. Here it's a bit more tricky. Yes?
So this is for companies with more established cash flows, even early stage.
This valuation we do for preclinical products and clinical products. Yeah. So negative cash flow, no revenues. I always have people, telling me, well, we are interested in evaluation, but we are preclinical, pre-revenue. We don't have any revenue, and that's normal. That's what we do. I mean, this is in this business. I would be surprised if you have revenues. So yeah. So in terms of the discount rate, just again we come back. I showed you the 20% discount rate for this example gives us 8 million. If you use 25%, it goes down to 2 million. If you use 15%, it goes to 21 million. So, sorry?
You mean 2.1 or what is it?
21.
Oh, 21. Okay.
Yeah, because if you reduce the risk, if you reduce the discount rate, the value goes up. But there is, unfortunately, it would be great if we just have a magic formula and which discount rate, but it doesn't exist. Now, the next thing is now the risk adjustment. So this is the probability that the product will go from phase 1 to phase 2 to phase 3, to approval and then to the market. So here there is data. There is historical data, and this is from a Nature publication. I don't know, it's not so clear, huh? It's better, huh? So this is from a Nature publication, and what they did, they went back and looked at all the trials and what were the success rates. And this is, either the products reached the endpoints or they didn't, and then, it was failure or not. And they looked at the different indications, and they looked at the different stages. And what you can see is the riskiest, the most difficult is oncology. So here we have a 7% probability to get likelihood of approval from, I think it's from phase 1 all the way to the market, 7%. And infectious diseases, we have a 17% probability. And you can see also for phase 2 and phase 3. Phase 2 is the riskiest. Here you try to show efficacy. You try to show that the product actually works. And that's where most of the products fail. So this is, if you show that, then you're a big step ahead. But this is the riskiest part. Yes?
So if you're thinking from like a smaller biotech perspective, is there a way to sort of account for the preclinical risk too of like coming through the FDA IND and whatnot before you get into phase 1?
There are also probabilities for that, depending on what you already have. If you don't have anything, no tox, no animal studies, then obviously your risk is higher. And so here there's I don't have any data here, which, but you could say if you don't have any clinical data, sorry, no preclinical data yet. It's no tox, no animal. So maybe 65% probability that you can get to phase 1. So that's something, just to give you a kind of an idea where that could be. Mm-hmm.
So you don't take the indication into consideration during the first stage where we talked about the development costs?
Yes, first, also for phase 1. Phase 1, there's also data for each different indication.
Sorry, I meant part of your valuation process where you talked about the first stage during the development costs.
You take the probability for phase 1. Or
No, in your model. So your first step.
Yes,
where
the
you talked
development
about
cost. Yeah.
Yeah. So you talked also about the stages, like phase 1, phase 2,
Yes,
phase 3.
correct. Mm-hmm.
So you don't take the indication for the drug into consideration until
For this, to calculate this, no, we do. I mean, for an oncology drug, you have different trial costs. I mean, then for maybe a dermatology drug, for example, which is easier, and also, so that it depends. The cost of the trial depend on the indication.
Okay, and then you just add the probability on at the end as well.
Yes. So what we do now, and this is kind of, so it's a decision tree. So basically, you start preclinical, or you start, or here we are phase 1, and then either you're successful in phase 1 or you're not. So you have a probability. You have to spend the money to do, for phase 1 to find out if you're successful or if it worked or not. So if it worked, you go to phase 2, and you have to spend the money for phase 2. And then at the end, again, you have a probability that it worked or not. And so it continues. And at the end, you have a combined probability that you get all the way to the market. Here again, 11%. And there are probabilities that you actually won't get there. So there's probabilities that you spend a certain amount of money to get at the different places. So you can calculate that, and at the end is this decision tree.
So why does it get done at the end and not in the first step?
Sorry, get what done?
The probability, why is it calculated at the end of the valuation model and not in the first step?
It's at every step it's used. You have a different probability. So here we have a 36% probability that phase 1 is not successful. So maybe there was a problem with the healthy volunteer that we had. And there's a 64% probability that everything was fine, that we can go to phase 2. And then we do phase 2, there's a 32% probability that phase 2 was successful. We could show efficacy, what we wanted to show, or a 68% probability that we couldn't show any efficacy, and we have to stop. Checking a bit on time. So the impact now, having these probabilities of success, so the impact on valuation is that your value, as soon as you successfully complete a clinical trial, your value will jump up because you eliminate that risk, right? So what happens with our 8 million with the in phase 1, when we complete phase 1 successfully, the value jumps to 18 million. If we complete phase 2 successfully, we go to 125 million because we can eliminate that risk. So the value is actually not really linear, but you have these steps. And this is exactly what you see when you look at the stock market. A one-product company, if they report a failure or successful completion of a clinical trial, the stock price will jump. It will either jump up or down. And this is exactly because the risk is eliminated. And even big pharma companies, if they report a failure or success in a late-stage clinical trial, you have an impact on the share price. Because that's future revenues that will go bust or will materialize. So obviously for big pharma companies, they have a whole portfolio, so the impact is not so big. But for biotech companies which only have few products or only one product, this exactly translates into the share price. So how can we use that then for negotiation? So what we do is we do evaluation of the full product. What's the value of the product and what's the value today? Now, when you do a licensing deal, that means you're sharing the value of the product. because a big pharma will not do a deal if they cannot capture part of that value. And for the biotech, obviously, they want to keep some of the value. So the question is, how do you, how is that shared? And at the end, that is determined by deal structure. So depending on the deal determines how much of the value the two parties get. And so when we look at different deal structures or look at the deal, we first do the valuation, then we look at, either you can say, okay, we want to do a 50-50 deal. What does that mean in terms of what kind of upfront milestone or royalties? Or you have a deal, and then you see what kind of share does that translate to, who gets how much of the value. So with the valuation, 1 million upfront payment, this is 1 million today. There is no condition in a deal, I get that 1 million today. So the RNPV of that upfront payment is 1 million. But 1 million payment in finishing phase 3, that has a RNPV, a lower value. So in this example, it's 8,000. So if you hear about these $500 million deals, this is money that will come maybe at some point in the future. So the present value of that is much lower. So valuation actually helps us also to see what is the value of 1% royalty. So if you negotiate with a pharma, you can see, okay, I want maybe have a lower royalty, but I want to have a higher upfront payment. And valuation can actually help you to understand, what's the value of 1% royalty. So in this case here, it will be 700,000. So valuation can help you with these metrics. And so that can help to show also, to compare different deals. You may have a front-loaded and the back-loaded deal. Front-loaded where you get a lot of upfront, and the back-loaded where you have a higher royalty. And it looks quite different, these deals, but actually at the end, in this calculation, there's the same value. It's just a matter who takes how much risk. Here, the biotech doesn't take a lot of risk. The pharma takes the risk because they pay now a high upfront and pay lower royalties. Here, the biotech takes a higher risk because they are waiting to get a big share of the value only with royalties. So valuation can help also to compare different deals with each other. So, I don't know, I have a case study I can go through quickly and show you. So, it's a mid-sized pharma company that wants to in-license a product from a biotech. It's in oncology. They've finished phase 1. We have the prevalence data, we know how long the patent lasts, and we have a proposal. Biotech says, okay, we want 20 billion upfront, 90 million milestones, market entry, and 10% royalty. So the question is, would the pharma company go for that deal or not? So what we do, we look at the market, we try to see what are the revenues, what are peak sales. You can see here we have 1.6 billion in peak sales. We look at the competition, what other products are there on the market, what other products are in development. We also look what's the probability that they will make it to the market. Then we do the calculation. We have the population, we have the prevalence, the diagnosed, we have the market penetration going to 100%, and we calculate what are sales, what are possible sales. This is Europe. You can do then for the US. You can do it for Japan, and you get your revenue, potential revenues. Then we look at the development costs. So phase 2. So we finished phase 1. So phase 2 would be 18 million. Takes 2 years. Phase 3 we would need about 4,200 patients. We have about patient cost. So we can calculate what the cost would be for phase 3. And approval, we assume it will cost $3 million and will take a year. Then we have different costs, the sales and marketing costs, the manufacturing costs. I'm not going into detail. Obviously, you can be more sophisticated in looking at that. I took a percentage now. That makes it easier, obviously, to do that. So different costs once the product is on the market to calculate your free cash flow. And again, you have your development cost here that we calculated for the different years. When the product gets to the market, we have then revenues, we have the sales, we have different costs. So we get our free cash flows at the end of the day. And we use that then to discount and to risk adjust. We have our success rate, so in oncology, because we finished phase 1, so we don't use the phase 1 probability, but we use phase 1, phase 2, phase 3, and approval risk. So we have a cumulative probability of 19% that we would apply in this case. So what's then important, your phase 2 costs, they will happen anyway, right? There is not a probability that we don't spend the money. We have to spend that money to find out if we're going to be successful or not. So these costs are 100% that we spend that. Now the phase 3 cost, that is we only going to spend when we are successful in phase 2. So your probability to spend phase 3 costs are the probability for phase 2. So that's a bit, so it's off always by one phase. But basically we use that to calculate the risk-adjusted net present value for each year and add that together, and that gives us a product value. So in this case we have a product value of 53 million for that particular product based on this calculation. Now the next step, we have the deal. Just to have a quick look.
And sorry, that's 53 million before phase 2, or?
That's 50, yes.
Before phase 2.
That's at the end of phase 1, before phase 2, exactly. That's the value. Now, the biotech's proposal, 20 million upfront, 9 million in milestones at market entry, 10% royalty. So with that proposal, the pharma company will get 28% of the value, and the biotech will get 72% of the value. So obviously, probably a pharma company would not go for that deal, right? They would probably try to negotiate a better deal for themselves, depending how badly they want the product. But a fair deal, fair meaning here 50-50, if you split the value 50-50, would be more something like 6 million upfront, 90 million milestones, and 10% royalty. So that would be something, or 20 million upfront and 6% royalty. So these are kind of deals that maybe people would try to negotiate. But at the end of the day, it comes back to supply and demand, right? So maybe this deal is still going to happen because the pharma really, the mid-sized pharma really wants that product. But this is how we would do the valuation and try to see, how does the deal look like. But it's always based on the valuation of the whole product. So just to conclude, and again, trying to be on time. So one of the things, valuation is very important. I mean, for biotechs, for life science companies in general. I mean, if you fundraise, if you try to do a deal, if you look even at the portfolio in terms of where to put the focus, valuation is a key aspect. Unfortunately, there is no, it's not. People say valuation is not. It's not a science. It's more an art. And some people say it's a black art. So I leave that up to you. But it's not an exact science. It's not. You have a formula. Everybody does it the same and gets to the same result. That's not the case. And value is, at the end of the day, it's the future potential and the future risk. So that's what determines the value. And at the end of the day, it's all about the assumption. It's not about the calculation. That's the easy part, but it's about the assumptions that you take. So I always tell people, I can do any valuation you want. At the end, it really depends on the assumption. So when you do evaluation, spend more time on the assumptions and not the calculation. You know, you can calculate yourself to death, but you know, at the end it's really the assumptions that matter and not the calculation. Good. I hope that gave you a little bit. It was like a fast train through evaluation. As I said, you know, you can spend on this topic a whole day, a whole week, probably on these different issues. My goal was just to give you kind of a quick introduction how evaluations are done, so you have a bit of an idea. Also, if you talk to somebody in the future, what are the important points? So I hope I give you a little bit of a background and an insight. I will put the slides on our website so you can download them probably from tomorrow or the day after tomorrow. And if you have any questions, I'm happy. I'm here all day, and maybe you have a few minutes now as well. But thanks very much for coming. Thank you.